If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future.
Warren Buffett's plan for investing is easy to understand. Most people know him for his value investing. His company, Berkshire Hathaway, wants to buy a business that is well run and has good economic characteristics that will last. He wants to find companies that are undervalued by thinking of them as cigar butts, which are used cigars that people ignore but that still have a few risk-free puffs left. Buffett thinks that you should look at long-term economic value after taking into account all costs, not just the ones that are considered accounting costs. He said that investors should only put money into businesses that are not too hard to understand in order to figure out their intrinsic value.
But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny, tiny, tiny amount of money.
He was able to get such high returns even though he didn't have much money because he was willing to take more risks. So, for example, if a stock is worth about $1 per share and it only trades about 100,000 shares a day, that means that only about $100,000 is changing hands in that one security. This means that if you want to buy a $1 million position in that stock, it will take you months to get there. So, the more money you have, the harder it is to take advantage of these smaller stock opportunities. This is because smaller stocks don't trade as often and don't move as much money. But again, there are good chances in these small companies to grow your money very quickly. As your money grows, you need to become more conservative and meticulous about how you invest it. It's much easier to get back 5% of $10,000 than 5% of $1 billion.
So I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But
when Buffett says that these opportunities were easier to find 40 years ago, this is because 40 years ago, people found stocks by pouring through books and manuals like the Moody's Manual. I'm sure that not too many people did this, so there wasn't much competition to find undervalued smaller companies. Stock market scanners are tools that can be used by anyone with a platform for trading stocks. You can tell these scanners exactly what you're looking for in a new investment, and they'll search the whole stock market to find shares within your range quickly and easily. Since everyone can now screen the whole market in a few seconds, it's getting harder and harder to find mispriced shares, but they are still out there.
I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it.
This is where you, as an investor, have an edge. There is a chance for a high rate of return when you work with small amounts of money. We talked about this a little earlier, but now let's talk about why this is the case. This is because of three main things. The first reason is that hedge funds and analysts don't pay attention to smaller securities because they can't invest their large amounts of money in them. So, like Warren Buffett, they don't even look or pay attention. The second reason is that because these undervalued opportunities aren't covered as much, fewer people know about them. This means that there is much less competition. And the third reason is that these small companies don't get much attention from the media, and many people avoid them because they are seen as risky investments. Berkshire Hathaway just focuses on the multi-billion-dollar industry now, because this is where they can actually use a lot of Berkshire Hathaway's capital, which is again why there is so much opportunity in these smaller securities. It's because these big hedge funds don't care about these small businesses with few assets.
When you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals, and I did it twice. And I actually, looked at every business. I didn't look very hard at some.
When looking for good businesses to invest in, investors have to do it on their own and use their own knowledge and intuition. He also said that smart investors should learn what they know and what they don't know and move very quickly when they see something they think is a good chance. Warren Buffett sticks to what he knows, which is why he consistently invests in oil companies and financial institutions like Bank of America. And remember that Warren Buffett always says to stay within your own circle of competence, whether you're investing in a small security or a large cap company. This really applies to all investing, no matter what you're looking at. Buffett said that when you put money into an investment, you can't look for people who agree with you. You can't just look around and expect people to understand what you're saying.
That's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. That's such a small world. It may be a way for one person to come up, but it's a long slog.
Munger shows that your investing strategy should be simple, but not overly casual or low effort. Some people on Wall Street think that they can easily make a lot more money by putting other people's money at risk. Buffett and Munger can't help but laugh when hearing about these types. Too many people look for easy money. The point of the interview is that you have a small amount of money to invest. You can take advantage of stock market opportunities that almost guarantee returns that no investor with more money could get, as long as you work hard. Don't wait to get started if you want to be as rich as Warren Buffett. At Berkshire Hathaway's annual shareholders meeting in 1999, when he was asked how to make $30 billion, which was about his net worth at the time, he gave this answer.
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old.
The Oracle of Omaha said that if he had been a college graduate in 1999 with $10,000 to invest, he would have been smart about where to put his money. I'd probably focus on smaller companies because I'd be working with smaller amounts, and there's a higher chance of missing something there, Buffett said, adding that he would start looking at companies in alphabetical order and work his way up. Keep in mind that Buffett thinks of buying stocks as buying a piece of a business. That's a good way to look at it. In his most recent letter to Berkshire shareholders, he said that he and Charlie Munger, his longtime right-hand man, are not stock pickers. We are business pickers. Buffett is also a big fan of index funds, which hold all the stocks in an index and are automatically diversified because of this. Buffett said in 2017 that people who want to get rich should always buy an S&P 500 low-cost index fund. Keep buying it through good times and bad, but especially bad. You should only invest in businesses you know something about. Warren Buffett has done this for most of his life. IT grew in the 1990s, and most investors put their money on it. He didn't do it though. because he thought technology was too hard to understand. Diversification is good, but don't do too much of it. He thinks that diversification only works up to a certain point and doesn't help reduce risk after that point. So, investors don't need to have a lot of stocks. When asked how long he thinks a stock should be held, he always says, forever. You don't have to take it literally, but you get the point. Stocks are never about the short term. Think of stocks like you would a sale on cheap furniture. He says you try to get the best deal when you go shopping for furniture. If you believe in the value of a company, you should continue accumulating and holding a share of it, even when others step over it, like a discarded cigar butt.